Hello everyone, welcome to our second lecture about in the stock market series. So, why would you actually invest? So today what we are going to talk about, the compound effect of money. We are going to talk about the compound magic, the compounding, what your makes your money compound itself. That create, generate, and generate more wealth, or create generational wealth. So, majorly. Today we are going to be talking about compound magic or the compound effect of money. So compound interest is when the money you earn starts earning money. Is it explained or I tell you more? Yeah, so mainly in case you have 100,000 shillings and then an interest of 20,000 shillings, is what called fixed interest. So for fixed interest, you'll be earning the interest even if you invest for like 6 months. The interest will be earning will be under 100,000 each month. But when you it's compound interest, and let's say you've got an interest of 20,000, so the first time you get interest on 100,000 shillings and you get an interest of 20,000, so it means you have 120,000 shillings on your account. So the interest you get will be on 120,000 shillings. Let's say this time you get an interest of 40,000 shillings, so 120 plus 40,000 shillings will be 160,000 shillings. So you know now this interest you will not be earning it on the 100,000, but will be earning it on the 160,000 shillings. So that's how money compounds. That's how you earn money on your money. You earn interest on interest. Yeah, that's the beauty of the compound magic that we're talking about today. And compounding is the easiest way to get wealth. So that we've talked about it. Isn't it tantalizing that it compounds to compound itself to increase your wealth generation? Yes, and here in actually the compound magic, we believe the sooner you begin investing, the more time your earnings have to compound. So if you begin early to invest, that compound effect of money per month will be also take its course. So if I start investing at my age, or some other young person started investing at 18 years, for you, you begin at 30 years. The compound effect of money for this young person at 18 years, it's going to be so vigorous than yours, because when you subtract 18 minus 30, that difference of years and months that this person at 18 is able to gain above you is far stronger than you at 30 years. So it's just simple. The earlier you invest, the earlier you invest in shares, the earlier you invest in unit trust, the earlier you invest in treasury bills, the earlier you invest in the cross-listed companies, the more the compounding magic or the compound effect of money will take its course. So here they say compound interest is an investor's best friend. As I've talked about it, it's of course it can't not be your best friend. Compounding is simply when the money you earn starts earning money. This means your stash is growing faster than if you are simply adding a lump sum every month. So what this means is that the way your money is growing, it is growing at a faster rate than when you'll be getting, let's say you are investing 20k, 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 and without gaining any compound interest, or when you are earning fixed interest on just your 20k, 20k. But in this compound effect of money, because you'll be earning interest on interest. The interest you gain will be giving you more interest. The other side of fixed income, you don't be getting any money on what? On your interest. So that's why it's a better way of investing, and the stock market does it better. The shares do it better. The unit trust do it better, and the treasury bills do it better. So here they say, so many people say, I cannot afford to start investing. The truth is, you can't afford to start investing because time is the issue here, not money. Compound interest is the real silver bullet when it comes to growing your wealth, and the earlier you start, the more powerful it becomes. So as I've told you, the earlier you start, as the analogy I gave you back of 18 years and the 30 years person, and the 30-year person is better than a person at 50 years or 40 years, but the person at 50 years is better than a person who has begun at 70s. Yeah, so majorly that is it. Yeah, so here they say a government bond can might give you a 5% per year, a 10% annual return in the historical average for the stock market, and 15% is what you get if you learn how to pick your own stocks and take advantage of the learned skill. So the things I'm telling you about, teaching you about, you can be able to gain unaveragely or a better return at 15%, because most government bonds annually can give you around 5%. Yeah, so those are the things. Yes, so mainly if you had put your money in a savings bank account, you will you find the interest you are getting is being eaten out by inflation. For example, here in Uganda, inflation is running at 5-6%. And what interest are they charging us, or are they giving us on our bank accounts? Around 4 or 5%. Um, so, but many of them are 4%. So that difference, let's say 6%, the difference is 2%. So your money is being eaten out by 2%. And the compound effect of money is that in the stock market can be able to fight or detach you from your money being eaten out by inflation, because these companies grow and these companies change with changing economic activities or other factors. So, in conclusion of the compound effect of money, it mainly or majorly entails you to begin as soon as possible, so that the effect of the compound effect of money can take its place. If you can be able to invest for your children, beautiful. If you can be able to invest for yourself, tantalizing. If you can be to invest for advise somebody to invest however order they are, that will be exquisite. But as long as somebody starts. So majorly that's the compound effect of money, earning money on your interest or earning interest after interest. In that way, you are not fixed that you're earning money, you're earning interest, you're earning it on only your principal, but here you'll be earning money on your both your principal and your interest. Thank you very much for listening to me. And as concluding this second lecture, have a peaceful